All right, let's get right into this explainer. Today, we're unpacking a really fascinating corporate narrative. We're taking a hard, data-driven look at Carnival Corporation. We're going to treat this as a focused, full due diligence report. Look, if you track the travel sector, you already know the cruise industry just sailed through an unprecedented storm over the last few years. But if you look at the recent SEC filings and earnings releases, they're painting a picture of a frankly stunning financial recovery for Carnival. So we're going to break down the numbers, the overarching strategy, and the lingering risks to figure out exactly what's happening beneath the surface of this massive turnaround arc. Okay, let's dive into this. $3.1 billion. I want you to keep this massive number locked in your head because it really anchors our entire analysis today. This represents Carnival's record full year 2025 adjusted net income. And to put that into perspective, that is up over 60% from the prior year. When we're doing due diligence on a turnaround stock, the absolute first thing we look for is a return to formidable profitability. Seeing a 60% jump that lands at over $3 billion in adjusted net income sends a loud and clear signal that their core business engine is officially roaring back to life.
Here is our blueprint for today's explainer. We'll be covering 1. Financial health and earnings, 2. Return of shareholder value, 3. Managing the debt load, 4. Navigating crucial industry risks, and finally 5. Future outlook and propel. Let's get to it.
Section 1, Financial Health and Earnings. The raw data we're pulling from the recent releases reveals a powerful story of corporate recovery and some really exceptional top-line momentum. And there's a quote from CEO Josh Weinstein that really humanizes the data we're about to look at. Following up on their incredible 2025, he stated, "We delivered a strong start to the year with record first quarter operating results that exceeded our guidance. In fact, that close-in demand drove record revenues of $6.2 billion in just the first quarter of 2026 alone." What you should take away from this is that consumers are absolutely still aggressively booking vacations, and Carnival is showing immense pricing power at historically high prices. And this brilliantly illustrates that pricing power actually translating into core profitability. For full year 2025, operating income hit an all-time high of $4.5 billion. That is a 25% leap from the prior year. Revenue is great, sure, but operating income tells us they're actually making money on those revenues before interest and taxes. A 25% increase shows fantastic operating leverage, meaning their costs just aren't rising as fast as their ticket prices. Which leads us directly to this metric, 13%. This is Carnival's adjusted return on invested capital, or ROIC, for 2025. Now, for those of us really focused on financial health, ROIC is a gold standard metric. It tells us exactly how efficiently management is using the capital they've invested, in those massive ships and infrastructure, to actually generate profits. Exceeding 13% proves their capital allocation strategy is highly efficient right now. They aren't just growing for the sake of it, they are growing profitably. But, it's not all perfectly smooth sailing, which actually makes this next part pretty fascinating. In their Q1 2026 update, Carnival faced a massive headwind, over $500 million in extra costs, just due to higher fuel prices. Fuel is obviously a massive vulnerability for cruise lines. Yet, despite this $500 million hit, management used really disciplined cost management to squeeze out nearly $150 million in operational improvements to add right back to their adjusted net income. Turns out, filling the gas tank of a 100,000-ton floating city isn't exactly cheap, but they're actively fighting those macroeconomic pressures with internal efficiencies. Section 2, Return of Shareholder Value. Now, what's really interesting about this slide is how it maps out the cash, because ultimately, record earnings mean very little if they don't eventually translate into value for the people holding the stock. Take a look at the dividend history. 2019 saw a healthy $2 per share total. Then 2020 hits, it drops to 50 cents, and then, a 6-year drought that probably felt like an absolute eternity to income investors while the company fought to rebuild. But February 2026 marks the triumphant return of the quarterly dividend, starting at 15 cents. This isn't just about the cash, guys. It's a massive psychological signal from the board of directors showing real confidence in their sustainable cash flow. And they definitely didn't stop at the dividend. Alongside that reinstatement, Carnival authorized a massive initial $2.5 billion share buyback program, returning $2.5 billion to investors while simultaneously restarting the dividend. That's management aggressively declaring that the crisis era is officially over. All right, Section 3, Managing the Debt Load. However, as diligent analysts, we have to acknowledge the heavy leverage they incurred just to keep the lights on during the recent industry downturn. So, the crucial point is their net debt to adjusted EBITDA ratio, which sits at 3.4x. Achieving a 3.4x leverage ratio is a monumental milestone. Why? Because it officially secured Carnival an investment-grade rating from Fitch. That directly lowers the interest rates they'll have to pay when they inevitably refinance their obligations. And trust me, they are going to need those lower rates when facing what is basically a debt wall. Based on their February 2026 filings, let's walk through this schedule. They owe roughly $2.5 billion in 2027, almost $4 billion in 2028, over $4 billion in 2029, and nearly $3 billion in 2030, with over $11 billion thereafter. Now, while their current $7.2 billion in adjusted EBITDA shows they can absolutely service this, actively managing these maturities over the next 5 years is for sure the central task for Carnival's finance team.
Section 4. Navigating crucial industry risks.
That massive debt load makes the company inherently sensitive to outside shocks. In their 8K filings, management is very clear about the continuous macro threats they face. On a global scale, geopolitical uncertainty and war heavily impact travel desires. Operationally, you've got adverse weather and climate conditions that can severely disrupt scheduled itineraries. Then there are the digital threats, like cybersecurity incidents targeting their networks. And as we already saw with that $500 million hit this quarter, fuel supply and cost fluctuations remain a highly volatile variable, right alongside broader supply chain vulnerabilities. As objective learners, we've got to constantly weigh these continuous macro threats against their internal financial improvements. Finally, Section 5, Future Outlook and Propel. So, how is Carnival planning to keep the momentum going and navigate those risks through the rest of 2026 and beyond? Let's move to and see how this builds into their newly announced long-term corporate strategy, which they call Propel. Carnival introduced these ambitious Propel targets specifically designed to reflect continued earnings growth momentum all the way through 2029. It's essentially their public roadmap, signaling to the market that they're no longer just recovering. They are plotting a multi-year course for sustained, responsible growth and returns. We can actually see the immediate first steps of that roadmap in their updated full-year 2026 guidance. They're projecting an adjusted earnings per share of approximately $2.21. They expect adjusted EBITDA to remain incredibly strong at roughly $7.19 billion. And perhaps most importantly, they expect net yields to be up about 2.75% in constant currency. That yield metric is absolutely vital. It proves they expect to maintain their historic pricing power and fill their ships, effectively absorbing those volatile fuel costs we talked about earlier. We've covered a lot of ground today, from a 60% leap in net income and the return of the dividend, all the way to a towering $25 billion debt wall and those tricky fuel costs. So I want to leave you with this question to ponder as you continue your own research. Are Carnival's record-breaking bookings and ambitious Propel targets actually enough to sustain this incredible momentum against the lingering, unpredictable macroeconomic risks in the world today? It's a fascinating tension between corporate efficiency and global volatility. Thanks so much for joining me for this explainer, and keep learning.